When a country spends years buying gold and then suddenly starts dumping it by the ton, the average investor makes the same mistake every single time. He thinks the story changed. I usually think the country got margin called. That is a very different interpretation. An interpretation is where money is made or lost. If you own gold, gold miners, silver, or any precious metals exposure at all, then what matters right now is not whether the chart looks ugly for a few weeks. What matters is whether you understand who is selling, why they are selling, how long they can keep selling, and what happens when that selling exhausts itself. That is the entire game. Most people will never do that work. They will watch the price fall and tell themselves one of the usual bedtime stories: profit-taking, overbought. Technical correction. Bubble finally popped. Financial television likes those phrases because they are easy to say and impossible to disprove cleanly in real time. I have very little use for that kind of commentary. I want the mechanism. Because if you understand the mechanism, a frightening move can stop looking like the end of a bull market and start looking like the most violent clearing event inside it. That is my frame. And the frame is simple. The Iran war did not merely make oil more expensive. It turned parts of the global gold market into a sovereign pawn shop. That is the mother line of everything I want to say. Not a retail pawn shop, not a hedge fund margin desk, a sovereign pawn shop. Countries that spent years stacking gold to reduce their dependence on the dollar are now being forced to hand that gold over for dollars because the war has changed the arithmetic of survival. If you do not understand that, then gold's recent weakness looks contradictory. If you do understand it, then the weakness becomes legible, and once it becomes legible, you stop reacting like a frightened spectator and start asking the only question that matters. How long can the forced sellers keep pawning the family silver before the window closes and the next phase begins? That is the right question. Now let us begin where the pain begins. A lot of people like to talk about central banks buying gold because it sounds strong, deliberate, strategic, and intelligent. And much of the time it is all of those things. Nations buy gold to diversify reserves, reduce dependence on foreign paper assets, and hold something that does not require another government's permission to keep existing. Fine. That is the strategic story. But strategy changes instantly when a system runs short of dollars. A nation can respect gold deeply and still be forced to sell it if the short-term need is not philosophical but immediate. That is the first mechanism. I call it the dollar gap. Gold is a reserve asset. Theory language, they are paid in dollars. Imported food does not accept speeches about monetary independence. It wants settlement. Military procurement does not accept nationalism in place of hard currency. It wants settlement. If a country imports almost all of its energy, and that energy suddenly costs dramatically more, because war has disrupted the region through which the world's oil is moving, then the problem is not whether the central bank still likes gold. The problem is whether the country has enough dollars to keep the machine alive. That is the dollar gap. The country needs more dollars than it is generating. When that happens, in quiet academic language, people call this a reserve management decision. I prefer to call it what it feels like. A margin call, that is the second mechanism. I call it sovereign collateral. Most people understand margin calls at the level of a retail brokerage account. The position moves against you. The broker wants more collateral. You either provide it or you liquidate something. Fine. That logic is not confined to small traders. It scales upward into states, balance sheets, and reserve systems. If a sovereign has promised too much stability relative to the dollars, now available to defend that stability, then it begins selling what the market will accept as credible collateral. Gold qualifies perfectly. That is why the country ends up in the sovereign pawn shop. It walks in with metal it spent years accumulating in order to escape the very system that is now extracting dollars from it. It does not do this because it stopped believing in gold. It does it because gold is precisely the thing valuable enough to pawn. This is what ordinary investors never seem to understand. A forced sale is not the same thing as a change of faith. If a nation pawns its gold to meet current obligations, the sale says more about the pressure on the nation than about the long-term reserve thesis behind gold itself. That is why I am so careful to separate motive from movement. Price movement alone tells you something happened. Motive tells you what it means. Now let us get specific. Turkey is the most visible example because the arithmetic is so brutal that even people who usually ignore the plumbing can see it if they look long enough. A country that imports the overwhelming majority of its oil and natural gas is effectively short dollars whenever energy surges. In normal times, this is unpleasant but manageable. In abnormal times, when a regional war drives up energy costs, disrupts trade, frightens capital, and weakens the domestic currency at the same time, the situation becomes much harsher. That is where the dollar gap turns into a collateral event. Oil rises, import costs rise, dollar need rises, the local currency weakens, the central bank must defend credibility, dollar reserves drain, and then the nation looks around for something it can monetize quickly. Gold is the obvious answer, not because gold failed, because gold still works. That is the part you must hold in your head. A country under pressure is not selling gold because gold became useless. It is selling gold because gold is still recognized, still liquid, still trusted enough to be converted into dollars under emergency conditions. That is an important distinction. It means the sale is tactical, not necessarily. That is why I think so many people are misreading what is happening. They are watching a distressed seller and interpreting the flow as philosophical surrender. I do not see it that way. Now let me introduce the third mechanism. I call it the bathtub peg. If you want to understand why the Gulf states matter so much in this story, you need to understand how a dollar peg actually lives or dies. A peg looks stable from the outside because people confuse a policy announcement with a self-sustaining reality. It is not self-sustaining. It is maintained. The easiest way to think about it is as a bathtub full of dollars. When oil is flowing normally, the faucet is on. Dollars come in because the country sells oil and the world pays in dollars. Some dollars leave because the country imports food, machinery, services, and all the other things modern states require. That is fine. The faucet is strong enough that the tub stays full. Now imagine war disrupts the export routes or the confidence around them. The faucet weakens at the same time more dollars leave. Defense costs rise. Import needs rise. Capital starts looking for safety. Expats move money, investors hedge, companies reposition. The tub begins to drain. If the peg is to survive, the state must keep supplying dollars from somewhere. That is the whole point of the peg. It is a promise that the domestic currency remains exchangeable against the dollar within a defined structure. Once the market doubts the state's ability to honor that promise, the peg itself becomes politically and economically explosive. So what does the state do? It reaches for collateral. It reaches for gold. This is why I say the Gulf states, whether confirmed in every specific transaction or not, matter immensely to gold right now. Their whole monetary architecture makes them vulnerable to the same war, driven dollar squeeze. Even if the exact form of response differs country by country, one country has more reserve room, another has more export disruption, another has a pipeline that helps, another has a different reporting structure. Fine, but the bathtub logic still holds. If fewer dollars are entering while more dollars are leaving, The gap must be covered somehow. That is the peg under stress. And a stressed peg is one of the purest examples of a sovereign pawn shop event you will ever see. Now we come to the fourth mechanism. I call it the rumor premium. A reset does not need all the selling to be confirmed before price begins to reflect fear of selling. That is how markets work. They discount possibility as soon as enough evidence appears that the plumbing is strained. If one country sells visibly, investors ask who else might need to sell. If one region is short dollars, investors ask which other balance sheets depend on the same dollar flow. If official data is incomplete, the market starts using vault flows, London balances, ETF outflows, futures positioning, and all the other peripheral clues that build a composite picture. That is why rumor matters during a reset. Not because rumor is proof, because rumor becomes part of the expected supply function. And once expected supply rises, price weakens even before every ounce appears. This is what makes resets feel so nasty in the middle. Actual selling is joined by anticipated selling. Confirmed liquidation is joined by speculative front running. The market begins discounting not just what has hit the tape, but what might be forced onto it if the war drags on and the dollar gap stays open. That is why a reset can overshoot. That is also why the eventual exhaustion of that selling can become so powerful. Because once the rumor premium collapses and the distressed flow slows at the same time, price no longer has to absorb both realities at once. That matters later. But first we need to go through the ugly part, honestly. The fifth mechanism is what I call war funding metal. Some countries are not mainly selling because they are energy-poor importers with weakening currencies. Some are selling because wars cost real money, and that money has to come from somewhere. A country under military strain does not ask what would look elegant on a reserve management chart. It asks what can be turned into liquidity fast enough to fund the present. That is why I think people make a mistake when they try to collapse all official. Sector gold selling into one neat explanation. There are multiple seller types inside this reset. You have the energy importer, short dollars. You have the dollar peg defender. You have the war funder. You have the buyer who paused. You have the buyer considering monetization. You have the holder trying to sell before a legal or logistical door closes. Different motives, same tape. That is what the public sees as contradiction. I see a mosaic. And mosaics matter because they tell you which parts are likely to persist and which parts are likely to exhaust themselves. That brings me to Russia. This is the sixth mechanism. I call it the closing door. When a major gold-producing power changes the legal conditions around exports, that matters for two opposite reasons at once. In the short run, holders who do not want their gold trapped behind a new legal wall may rush to liquidate before the door shuts. That creates more current supply. The market feels weaker. The flow looks bearish. The public gets nervous. Then the door actually shuts. And now a meaningful source of future internationally mobile supply is constrained. In other words, the same policy can increase near-term selling pressure while reducing future available flow. That is exactly the kind of sequence ordinary investors misread because they are emotionally captive to what they see this week. The door closing mechanism is powerful because it intensifies the reset first and tightens the future later. That is why I care so much about dates, deadlines, and policy cutoffs. They can produce ugly short-term moves inside a longer-term supportive structure. Now we have enough pieces to say something useful about the bigger frame. I do not think this is the end of the gold bull market. I think this is a collateral call inside it. That is a completely different sentence. When the strongest buyers of the last phase become temporary sellers, the public assumes the story died. But what if the story did not die? What if the strongest buyers were forced to monetize gold? for reasons completely consistent with why they wanted to own gold in the first place. That is the crucial question. Why were these countries buying gold before all this? Because they wanted something outside the paper dollar system, because they wanted reserve insulation, because they understood that gold carries no political counterparty risk in the way foreign paper claims do, because they wanted a strategic asset, not a chart. Has any of that logic been invalidated by the fact that they now need dollars urgently during a war shock? No. If anything, the shock confirms their vulnerability to the dollar system even more clearly. That is why I think the long-term strategic case for gold can survive a violent tactical liquidation phase. The sale does not disprove the reason. It proves the system can force pauses, pawns, and temporary reversals even when the strategic motive remains intact. That is the reset, not the end. Now let us talk phases, because if you cannot locate the phase, you will confuse pain with destination. The first phase is forced liquidation. This is where we are when the urgent need for dollars overwhelms the desire to hold metal. Countries sell, swap desks fill, vault data looks heavy, London feels the pressure. Rumors spread faster than confirmation. Price weakens not because the world stopped respecting gold, but because too many official actors need the wrong currency right now. This phase is nasty because it is highly price insensitive. A distressed seller does not care that gold looks oversold on your chart. A distressed seller needs dollars. That makes the flow dangerous while it lasts. The second phase is stabilization. This begins when the dollar gap stops widening. Oil either settles or falls. Export routes adjust. Shipping reality improves. Panic slows. The stressed currency stops making new embarrassing lows every week. The peg is still expensive to defend, but no longer becoming more expensive by the hour. The central bank can breathe. The very moment the pressure stops worsening, the logic of forced selling changes, not disappears. Changes that is enough for a market to begin finding a floor. The third phase is strategic re-entry. This is the phase retail almost always misses. The countries that sold unwillingly stop selling because the emergency passed. The countries that pause start buying again because the structural reserve logic never changed. The countries that wanted to reduce paper risk still want to reduce paper risk. The nations that learned reserve vulnerability still remember the lesson, and now they return to a market that has already been reset lower by distress. That is when the same public that sold in the liquidation phase begins rediscovering the long-term story at worse prices. That is how these things usually work. Now I want to tell you what I am watching, because a framework without indicators becomes philosophy. First, I watch oil, not because I think oil predicts gold in a simplistic line way. I watch oil because in this specific reset it is part of the sovereign collateral chain. If oil stays high enough to keep energy importers starved for dollars, then the forced seller remains under pressure. If oil comes down and stays down enough to ease the external bill, then one of the major motives for reserve monetization begins to soften. Second, I watch the currencies under stress. If a country's currency or peg remains under attack, then the bathtub is still draining, and the central bank still has reason to pawn collateral. When the currency stabilizes, when the market stops testing the line with the same aggression, then the pressure on gold reserves can begin to ease. Third, I watch confirmed official selling versus speculative fear. These are not the same thing. If confirmed selling remains finite while fear of broader selling becomes exaggerated, then sentiment itself becomes part of the discount. Fourth, I watch policy doors. Export restrictions, legal cutoffs, new trade channels, sanctions adjustments, alternative settlement systems. These matter because they determine whether current selling is a one-time scramble or the beginning of some larger structural shift in available supply. Now, I want to say something about the long-term dollar story, because this is where many people lose the thread. A lot of investors look at the present reset and decide it must be good for the dollar because countries are selling gold to raise dollars. That is too shallow. In the short run, yes, the world is being forced to chase dollars. War, energy, trade, and funding stress are doing exactly that. But the longer this episode teaches countries how vulnerable they remain to the dollar system, the more it reinforces the strategic reason they wanted gold in the first place. Do not confuse immediate dollar need with permanent love of the dollar architecture. Those are not the same thing. The present crisis can strengthen the short-term bid for dollars while simultaneously strengthening the long-term desire to diversify away from dollar dependence. That is the paradox most people cannot hold in their head at the same time. You must hold it, because that paradox is why the reset can be so violent now and still leave the strategic case intact later. Now let me address the public mistake directly. The public thinks gold should rise whenever the world is unstable. That belief is far too childish for a real market. Gold can be strategically correct and still be tactically sold by nations who are desperate for the wrong form of liquidity. The better gold functions as collateral, the more saleable it becomes in a real emergency. That should not confuse you. It should clarify the nature of the asset. Gold is not failing when a central bank pawns it. Gold is being used. That is what a serious reserve asset is for. And when the emergency ends, the strategic desire to rebuild that reserve tends to come back. That is why I think this reset is so significant. It is not merely flushing out retail. It is forcing sovereign players to reveal how precious their metal really is by showing how fast they reach for it when the system hurts. Now let me bring in the miners, because many people will ask the obvious question. If gold is being dragged around by this collateral event, what does that mean for companies leveraged to the metal? Here my answer is straightforward. Miners can be more volatile than the metal itself because their margins, cash flow, jurisdiction risk, funding structure, and operating costs all add layers. The metal does not carry. That makes them wonderful when the metal runs cleanly, and dangerous when the tape is being shoved around by forced official sector selling. So I do not treat miners as the same thing as gold. Gold is reserve collateral. Miners are operating leverage to the metal. Those are different roles. During the liquidation phase, the leverage can feel vicious. During the reentry phase, it can become extraordinary. That is why phase identification matters so much. Now I want to close in Buffett language, not in television language. The television question is gold broken? I have no respect for that question. The adult question is, who is being forced to sell? How long can they keep doing it? And did the strategic reason for owning gold actually change? That is the only question worth asking. If the answer is that the sellers are distressed, finite, and acting against their own long-term preference, because the war widened their dollar gap and threatened their peg or funding structure, then the reset has a very different meaning from the one implied by a scary chart. It becomes a transfer event from the impatient to the patient, from the unprepared to the prepared, from the people who own narratives to the people who understand mechanics. And mechanics always win in the end. So here is the final choice. You can treat the current weakness as evidence that the gold thesis was just another emotional story that fell apart under pressure. That is what most people will do. Or you can see this for what it looks like to me. A sovereign pawn, shop event, a war-driven collateral call, a temporary conversion of strategic reserve metal into tactical dollar liquidity, a reset created not by philosophical rejection of gold, but by the cruel fact that countries cannot pay immediate obligations with theory. That is the choice. And if you make the second interpretation, then your questions become far better. How much forced selling remains? Which peg is still under stress? Which energy importer still has a bathtub problem? How much pre-deadline Russian liquidation is still left? When do the rumor flows stop mattering more than the confirmed flows? When does the strategic bid come back? Those are useful questions. They make you patient, they make you careful, they stop you from being emotionally bullied by a reset. You do not understand. And that is where I want to leave it. This is not a clean market. It is not a comfortable market. It is not a market where a falling price necessarily means a broken thesis. It is a market where sovereign stress is pawning collateral to buy time. Time eventually runs out for the seller. That is the hidden mercy inside every forced liquidation phase. The distressed flow always feels infinite while you are living through it. It never is. One country runs low, another stabilizes, one deadline passes, another route opens, one war bill gets funded, one peg survives another month, and eventually the market stops being run by desperation. When that happens, everybody suddenly rediscovers the long-term story. They rediscover it at higher prices. That is the usual punishment for emotional illiteracy. I prefer to understand the pawn shop while it is still open, because once you see the mechanism, the fear becomes much easier to price. And once fear becomes priceable, opportunity can begin. That is what this looks like to me. Not the death of the gold bull market, the largest sovereign collateral event inside it. Understand that, and the chart stops arguing with you. It starts explaining itself.